Have you ever heard of a currency with two different values at the same time? It sounds strange, right? But that's exactly the case with the Iraqi Dinar, or IQD. In Iraq, you'll find two exchange rates running side by side: the official rate, set by the Central Bank of Iraq, and the parallel market rate, which is what people actually use on the street. This isn't just a quirky economic fact. It affects the lives of millions and holds the key to understanding Iraq's economic future. Why does this happen? What creates this gap, and what does it mean for everyone from everyday citizens to international investors? Today, we're diving deep into the world of the Iraqi dinar to uncover why it has two faces, how this system works, and what Iraq is doing to bring them together. Let's get started. First, let's break down what these two rates actually are. The official exchange rate is the price tag set by the Central Bank of Iraq, or CBI. It's the official number of dinars you need to buy $1. For years, the CBI has kept this rate relatively fixed to provide stability and fight inflation. Think of it as the government's anchor in a sea of economic change. But then there's the parallel market rate. This is the real-world on-the-ground rate. It's determined by simple supply and demand in informal markets, like your local exchange shop or even just traders on the street. This rate changes daily, sometimes even hourly, based on how many dollars are available and how many people are trying to buy them. When the gap between the official rate and the parallel rate widens, it's a major red flag signaling underlying economic pressures, like a shortage of dollars, new import rules, or a general lack of trust in the official banking system. So why would a country have two exchange rates in the first place? It's not by choice, but a result of several complex factors. A primary reason is currency controls. To keep the economy stable and prevent money from flooding out of the country, the Central Bank of Iraq limits how many US dollars can be officially exchanged and sent abroad. This helps prevent what's known as capital flight, but it also creates a bottleneck. Iraq is heavily dependent on imports for almost everything, from food and medicine to electronics and cars. All these imports need to be paid for in US dollars. Businesses can't get enough dollars through the official channels; they have no choice but to turn to the parallel market. This surge in demand naturally drives the price of the dollar up. Then, there's the darker side of things: corruption and smuggling. Unfortunately, a portion of the dollars released by the central bank for legitimate imports gets diverted. Instead of paying for goods, it's smuggled to neighboring countries where the dollar is in high demand, further shrinking the supply within Iraq and pushing the parallel rate even higher. Finally, international banking restrictions play a role. Due to sanctions and strict compliance rules, some Iraqi banks have a hard time with international money transfers. This limits the official flow of dollars into the country and forces even more people toward those informal, unregulated channels. The Central Bank of Iraq, or CBI, finds itself in a constant balancing act, trying to manage both of these rates and close the gap. It has a few tools at its disposal. The most important one is the currency auction. On a regular basis, the CBI sells US dollars to commercial banks and licensed currency exchange companies. The goal is to inject enough dollars into the market to meet the demand for imports and keep the dinar stable. Another tool is adjusting the official rate itself. If the gap becomes too wide for too long, the CBI might devalue or revalue the dinar to better reflect what's happening in the real economy. The bank also plays the role of a watchdog, monitoring transactions to clamp down on money laundering and ensure that Iraq complies with international financial standards. In fact, in 2023 and 2024, the CBI, with support from international partners, implemented much stricter controls on how dollars are distributed. While this was a necessary step to fight misuse, it temporarily made it harder for legitimate businesses to get dollars, which ironically caused the gap between the two rates to widen for a time. It's a delicate dance between control and liquidity. For the average Iraqi, this dual rate system isn't just an economic theory, it's a daily reality that hits them right in the wallet. The biggest impact is on purchasing power and the cost of living. Here's how it works. Most imported goods are priced in US dollars. When the parallel market rate for the dollar goes up, the dinar price for those goods goes up too, regardless of what the official rate says. Let's take a simple example. Say the official rate is 1,320 dinars to $1, but on the street, it takes 1,500 dinars to get that same dollar. An imported smartphone that costs $100 should officially cost 132,000 dinars. But the importer had to buy their dollars on the parallel market at 1,500. So they're going to price that phone at 150,000 dinars or more to make a profit. This creates inflation that people can feel. The price of food, medicine, and electronics creeps up, making life more expensive. It creates a lot of frustration as people see the value of their salaries and savings shrink, even while the government might be reporting that the official currency rate is stable. So how does this parallel market actually operate? It's not a single, physical place. It's a vast informal network of exchange shops, individual traders, and business people who are constantly buying and selling foreign currency. The biggest hubs are in major cities like Baghdad, Erbil, and Basra. The rate in these markets is incredibly sensitive. It's influenced by the daily supply and demand for dollars, any new policies announced by the CBI, political news, and even security developments. If there's a rumor of new regulations, the rate can spike in minutes. Sometimes the supply of dollars in this market comes from unofficial sources. For example, traders might bring in cash from neighboring countries, or money from informal cross-border trade finds its way in. Because these transactions happen outside the official banking system, they create a massive shadow economy. This makes it incredibly difficult for the government to monitor, regulate, or tax these activities, which further complicates efforts to stabilize the economy. This situation hasn't gone unnoticed by the international community. The United States and other global financial institutions like the IMF have been pushing Iraq to clean up its act and increase transparency in its currency exchange system. The primary concern is to ensure that dollars flowing into Iraq aren't being used for illegal activities like money laundering or financing terrorism. This pressure has led the CBI to adopt much stricter rules. Now, anyone wanting to buy dollars through official channels needs to provide detailed documentation proving that the money is for legitimate imports. They've implemented a digital platform to track every transaction. These reforms are crucial for building long-term credibility for Iraq's banking sector. However, in the short term, they've had a disruptive effect. The new, stricter process slowed down the distribution of dollars, which, as we've discussed, pushed more people to the parallel market and widened the rate gap. It's a classic case of short-term pain for long-term gain. The hope is that, as the system becomes more efficient, these reforms will ultimately strengthen Iraq's financial system and help merge the two rates. The existence of a dual exchange rate has significant consequences for Iraq's economy and its political stability. For one, it damages investor confidence. Foreign companies are often hesitant to invest in a country where the currency has two different values. It creates too much uncertainty. How do you calculate your profits or plan your finances when the exchange rate you rely on is so volatile? This instability also encouraged the growth of black markets. When it's easier and faster to get dollars informally, more people will bypass the official system, which undermines the government's efforts to regulate the economy. Furthermore, it puts pressure on government revenue. Since Iraq's income is almost entirely from oil sold in US dollars, a fluctuating exchange rate can complicate budget management and its ability to pay for public services and imports. And perhaps most importantly, it fuels social discontent. As we saw, a weaker dinar on the parallel market directly leads to higher prices for everyday goods. This rising cost of living erodes public trust and can create significant political tension, as citizens blame the government for their economic struggles. So what's the path forward? How can Iraq bridge this gap and create a single, stable exchange rate? It's a massive undertaking that requires tackling both the symptoms and the root causes. The first step is to continue strengthening the banking infrastructure. This means making official transactions faster, more transparent, and more accessible for everyone. Another key move is to expand digital payment systems. The more people use electronic transfers and digital wallets, the less reliant the economy will be on physical cash, which is much harder to track and control. Economically, Iraq needs to diversify away from oil. By increasing non-oil exports, the country can bring in more foreign currency through official channels, reducing the pressure on the dollar supply. At the same time, the government needs to maintain strong foreign reserves. This gives the central bank the firepower it needs to defend the dinar's official rate and intervene in the market when necessary. Finally, it's crucial to continue the reforms that align Iraq's banking sector with global standards. If Iraq can successfully implement these measures, the parallel market will lose its appeal, and the gap between the two rates should naturally shrink. leading to a much more stable and predictable financial environment for everyone. In the end, the story of the dinar's two faces is the story of Iraq's economy itself, a story of challenges, but also one of incredible progress. This dual-rate system is a clear symptom of deeper structural issues, from an over-reliance on imports and cash to the persistent challenges of corruption and regulatory loopholes. However, it's also clear that Iraq is taking serious, concrete steps toward reform. The push for transparency, modernization, and integration with the global financial system is real. As these efforts take hold and the economy diversifies, the gap between the official and parallel rates is expected to close. This will pave the way for a stronger, more unified, and more credible Iraqi dinar in the years to come. For now, the dinar may have two faces, but they are both part of the same journey, Iraq's determined path toward economic recovery and a brighter future. Thanks so much for watching. If you found this video insightful, please hit that like button. And don't forget to subscribe for more deep dives into the stories shaping our world. We'll see you in the next one.